Today's conversation is all about where capital meets equipment finance. After all, the conversation is no longer about whether equipment finance is an attractive asset class, but rather what makes it investable and scalable. I'm joined by Quentin Cote of Concord Finance to discuss that trust layer, what investors need to invest and scale with confidence. Hello, everyone. My name is Daryl Muller, and I serve as ELFA's Chief Operating Officer and Corporate Secretary. And I'm joined today on Equipment Finance Matters with Quentin Cote of Concord. Hi, Quentin.
Hey, Daryl. Great to see you. And thanks for having me.
I was just thinking back that it was 3 months to the day that you and I sat down at the inaugural investors conference for a similar conversation, talking about kind of the future of asset-backed finance and its role in the equipment finance space. During that conversation, we heard a lot from capital providers about what they're looking for: structure, credit, sector exposure, management quality, and confidence. And then from the builders, about how companies are, growing, managing credit, accessing capital, and building more durable platforms. And our conversation was that bridge, thinking about the infrastructure behind the assets and what's required to create sustainable and scalable investment in the equipment finance class. And so I'm thrilled to continue that conversation with you today and kind of share that with kind of the broader EF industry as we see such significant growth from the private credit space. To kick us off, why don't you share a little bit about kind of like your background and kind of your experience in the industry and kind of what you're doing at Concord today?
Sure. So I was thinking back. I've been in the industry in various roles for over 30 years. So I started as a lender working for a bank in their securitization business. So working on all different asset classes, including equipment finance. Then I moved to be an investor. So I was doing equity investments in the same types of companies, including equipment finance companies. I moved on to be an originator. So I worked for a startup originator for a period of time. From there, I moved on to an operator. So I ran a small equipment finance business for a few years. And then finally, now I'm with a servicer. So we do loan and lease servicing and other services for finance companies. So it's been quite a journey. Seen the business from a bunch of different perspectives.
Yeah. I don't want to get ahead of our conversation by asking you what your perspective is on kind of the state of the market and the industry right now. So before we do that, share a little bit more about what Concord's doing and kind of the work that you and I have talked about, both on the consumer side as well as commercial side, and its relationship with the investor community more broadly.
Sure. Just over a year ago, in fact, it was a year and 10 days ago, Orion First was acquired by Concord. So a lot of people know Orion First as a long-standing 25 years in the industry business loan and lease servicing company. That was our specialization. Concord does the same thing, but in the consumer space. So considerably larger consumer loan servicing with added services. So in particular, what one might call the trust layer, things like custody and backup servicing as a specialization, eVault, and document verification. Those are all added services that Orion really didn't play a meaningful role in previously, where now we have that added capability. So it's sort of the same Orion staff and processes and business, kind of supercharged by the Concord capabilities.
It's such an interesting perspective to have, both your kind of experience in the industry and a variety of different roles, including having been on the investor side at one time, an originator, and then kind of in the services space. And I know Orion was really focused on working with small businesses. And now here we are kind of with Concord, thinking more broadly about, kind of the work that you're doing. You have this very unique lens. And so I'd be curious to get your perspective around, what you're seeing in the market and what you're hearing now, especially in the last year of integration under kind of a new flag of kind of what customers are saying and kind of how people are responding to what's going on.
So I think that, if you think about it from both ends of the value chain, you've got at one end of the value chain, you have the end borrowers. Good statistics we're seeing on the origination side and new business side. I would say that a little bit of it is skewed by the data center data, which isn't really is sort of a very distinct subsegment of the market. But otherwise, I think it's a pretty stable underlying small business and business investment scenario. Now, at the other end of the spectrum is the investor base, and that is changing quite a bit. So I would argue that our market has been very friendly to the bank market historically. It's an attractive product. Banks have recognized it, and banks have played a very big role in funding the equipment finance market. I think that shifted quite a bit in the last 3 to 4 years when rates rose. Banks have pulled back a certain amount, and filling that void has been the private credit market. And so you've seen a number of new entrants in that space. And with that, I would say comes a different set of disciplines, a different set of priorities, a different set of skills and qualities from what banks tend to expect or are accustomed to, and a bunch of different opportunities. So that's really been a big shift in our market.
I think it's interesting that you have talked about really multiple different sectors of our industry, the banking space, certainly thinking about the private credit service providers. And then, what we're hearing a lot right now is around data centers itself. And, we've historically seen this as like potentially the big opportunity, but you're referencing it as the stable component of kind of where the industry is going. What is kind of like, do you see a larger opportunity that people should be thinking about? Or on the flip side, what's really underappreciated as well in the market?
I think the verdict is out for me personally on data centers. I think that certainly there's a ton of capital going into it and a ton of a need. I think that's a little bit different from the fundamentals of equipment finance from the perspective of risk. If we're in the business of building portfolios of diversified assets that can withstand cycles and business risk. Data centers are very large single investments, and so at some level they're a bet on the future and sort of an economic model, but they're not necessarily exactly the same as what the basis of the industry is what I would say. So I think it's a creative opportunity to put money to work. But if I were sitting as a small business loan originator, I would be looking at the services those data centers require as much as I would the money needed for the data centers themselves.
Yeah, I'm not going to pull a thread there. I mean, we're hearing kind of mixed things, and you were here in Washington for Capital Connections not too recently, where the big conversation on data centers was certainly the NIMBY perspective of not in my backyard, from power generation to construction to kind of land usage. But when you actually talk to those data centers, we talk to our members, the story's a little bit different, right? Where what we're actually hearing is that they're generating their own power. They're kind of helping provide access to kind of, really critical digital infrastructure. What's your take, and kind of what's the conversation that you had either here in DC or now that you're kind of like back out traveling the country around kind of the role of data centers and kind of what that opportunity could be for us as an industry?
Data centers are great for chip manufacturers, and that's a great development for them. It's great for anybody involved in energy, as you said. And it's sure they produce their own energy, but somebody's got to build the plants and somebody's got to run the plants and provide services to those centers. So those are all the ancillary businesses are going to benefit from those large data centers. So I think there's opportunity there in our industry to kind of capture some of the qualities that we value in our industry with respect to the assets without being a direct investor in the data centers itself.
Two words you had mentioned throughout our conversation so far stuck out: risk and infrastructure. So let's reframe the conversation a bit and talk about what investors are really underwriting when they look beyond yield, collateral, credit performance. What does the operational discipline, reporting, controls, and transparency start to matter the most?
I think that as originators and asset owners and finance businesses, we often think about it as running a business. How to generate the highest return for our business and minimize the costs. But this question of infrastructure gets to the point of correlation, which is, the magic of securitization and asset-backed business in general is this idea that you can separate the portfolio from the business risk. There's sort of a couple fundamentals, and this is a big one, where the portfolio itself, you can borrow money more cheaply than the business itself can borrow money. So if you can separate the business from the portfolio, you can get very low borrowing cost at very high leverage. Then the question becomes, what does that mean? How do you separate the portfolio from the business? And why can you do that? And the reason you do it is you have a diversified portfolio of obligors who all owe money or generating a stream of payments, regardless of what the fortunes of that originator are post-origination. So the originator originates the asset, and now the borrower has the obligation to make a series of payments. Now, if you group them all together, you have a diverse portfolio of obligors that have an attractive risk profile and correlation that then is very, very predictable and very easy to analyze. But you have to really create a real separation between the assets and the originator. And that comes to a number of different things that sort of historically have been sort of check the box bits. I'll use backup servicing as an example. So backup servicing itself has been required by rating agencies for securitizations when the originator is not rated. The backup is there in case, for a very specific reason, if the servicer or if the originator servicer goes out of business, the backup steps in and performs primary servicing. That is precisely to reduce or eliminate that correlation risk. That's why it's there, so that you can get, because the borrower itself may be unrated. Unrated borrowers don't get great rates, but the portfolio itself can get fantastic rates. So that's an imperfect tool for separating because there's going to be transition risk. Taking on the portfolio is costly. It creates some amount of disruption, and minimizing that has become more and more important in the last 2 years because the recognition of it's not a check the box issue. It's actually, can you do it, and can you do it well and efficiently, and do you have the data that you need to do it? So that's an example of where I think that private capital stepping in and using the discipline that they're comfortable with or used to with securitizations, and asking for more discipline in the separation of the asset of the portfolio from the originator servicer.
I think that's really helpful to understand is kind of that minimization of the risk part of it, and then like a little bit of that other component of it, as we were mentioning, is the idea of the infrastructure and what does institutional grade infrastructure actually look like. Can you speak to a little bit about kind of what happens when a platform has attractive assets but lacks the infrastructure to keep pace with the growth of that portfolio?
There are other elements of this correlation risk question that are also related to fraud. So unfortunately, I would say fortunately, our industry has not been terribly subject to fraud. But in the specialty finance industry, we've seen several fraud stories come out in the last year to year and a half that have changed the outlook and profile and sort of focus of the private investor community and frankly the securitization investor community. So they've seen instances in the consumer space where there was a double pledging of assets, for example. So the question is, what kind of infrastructure can you put in, how quickly to kind of just eliminate that concern? Fraud is one of those on-off switch problems, which is either happening or it's not happening. It's not measurable. It's not quantifiable. So avoiding it at all costs is sort of is a primary tenet. So what do you do in that instance? You separate the collateral from the business itself. So you have a custodian to hold the collateral. You manage the cash in a way that's transparent and out of the reach of the business. You use e-vaulting to make sure that you have a definitive copy of every contract that you have. So there's a number of procedures and processes you can put in place to kind of create this infrastructure that builds the confidence of the investors, so they know that they don't need to do a kind of they don't need to wonder if there's fraud or if there's an issue with the underlying structure and quality of the assets.
As you may have seen, ELFA recently launched our inaugural research agenda, which are the major topics driving conversations today, but also ones we see kind of projecting the kind of future state of the industry. And we've tapped into a couple of those already. One certainly being kind of the role of AI, and I'd say or digital infrastructure on the industry, but also fraud was kind of what we think about as like our dark horse. You kind of emerged throughout many of the conversations, really towards the end of the process, coalesced around kind of how do we mitigate and manage it. And it kind of you're talking about that right now in the same way that we're seeing our banks talk about it, captives, and certainly independents as they kind of look at some of the existential or kind of outside industry impact that's been happening, and how do they get ahead of it here in our own space as well.
Yeah, I think that's exactly right. The topic first started coming up, I think, at last year's ELFA annual. It was sort of on the
Yeah.
tip of everybody's tongue. It wasn't necessarily infused in the topics that we were choosing to speak about, but if you know, it came up in almost every panel discussion at some level. And it's just that's back to that question of how do you create this level of confidence and trust that you don't need to have this unquantifiable risk in the portfolio or in your investment. So that definitely is an important topic. With respect to AI, that certainly is another giant transformative factor that we're all looking at and thinking about what its impact is going to be on the industry. And I'll tell you a little anecdote. So we had a service provider roundtable in DC before the Capital Connections, and we had a great Oxford style debate about the impact of AI on our industry. And I think the conclusion of the group was that this is still a very human business, and that and that's never going to go away. That small businesses and businesses have problems that need to be solved, and those problems can be handled by humans, and that personal connection is why a lot of people make decisions. It's not just about cost and efficiency; it's about relationship and trust. The same with vendors. If you can solve vendors' problems and build relationships with vendors, you can generate high quality assets in a way that a machine not necessarily can. So.
Yeah, I think that's one of our kind of major themes when we're talking about AI right now specifically, but also I think what's unique about kind of our industry is that it is a people first industry itself. It's like, who are the relationships, whether you've kind of come up through the industry like yourself and so many folks, or is that you're new to the industry. It's about building relationships. It's understanding kind of how you can get those deals put together. How are we financing and helping business growth happen? We see AI hopefully as that enabler, right, and an accelerator, and it goes directly into some of the platforms and the work that you're doing, help support and augment that work, so that teams will be spending more time, less on kind of hopefully the back end and the paperwork process, but more time on developing those relationships and creating really strong deals. We also know AI is the part that kind of help accelerate that fraud potentially as well, and that's where we are seeing it. So there's going to be some trade-offs throughout that process. And it makes me think about, as investors come into the space and are looking at kind of these multitude of different factors, what do you think they're going to demand from platforms and portfolios as the market evolves, as these issues continue to expand and kind of grow with kind of the evolving landscape?
Sure. One of the things that comes to mind, so I think you captured the issues well with respect to AI, right? I look at it from two different perspectives, one of which is automation, right? In terms of what processes can you automate that are repetitive and a machine does quite well. And the other is decision support. We're all making these incredibly important and difficult decisions that we have to make every day, like pricing and underwriting and market segmentation and portfolio management. All these things can be supported by AI to make better decisions faster, in addition to the automation. But your question about what investors are going to be expecting at a higher level, I think one in particular that comes to mind is this idea that we're going to need to provide data faster and more easily and more transparently. So access to the underlying data associated with every contract that gets originated, how it got originated, under what conditions, all this information and data associated with a contract beyond the FICO score, the PayNet score, and the time in business, which has sort of been a lot of the and the equipment type. Those sort of basics. There's so much more behind that that can inform the investor on the conditions under which it was originated, what we might expect in different environmental conditions, that can add to the color to the understanding of correlation and risk. So I think at some point we're going to be much more transparent with our investors in terms of what information they get, and investors are going to be using that data in new and different ways as well.
Yeah, I mean, data is kind of the core component, and what can we be unearthing, and how do we develop it, and where does it go? And one of the other areas that we're looking at is how do we think about the future of kind of where we're going, and so. What gives you confidence about the equipment finance industry, both attracting a deeper but also a broader pool of capital at this moment?
What's critical to this is there's one element has not changed, and that is that it's an industry and an asset class that has characteristics that are not changing. That is, they are diverse. Diverse by industry, diverse by situation, diverse by geography, and that very nature creates a very stable performance profile. And the construction of a portfolio or the act of purchasing multiple portfolios can create a risk profile that is unequal, I think, in the market. If you compare that, I'll be cynical and compare it to credit cards. So credit cards, you're buying the U.S. consumer economy because everybody's got 3 cards in their pocket, and it's not very differentiated between one originator and another. They're very similar. On the other hand, if you buy from Caterpillar or from even DeLaGa or from I'm not coming up with good names, but those are very different portfolios. They're going to perform very differently. The characteristics are different. And when you combine them, when you combine a farmer with a construction worker with a restaurant owner, you get a diverse risk profile that you just can't replicate in other markets. So those characteristics are fundamental and they're long lasting, and that's what's keeping us in the business, and what's gonna. This will be the truth 10 years from now as well as today.
So I'm going to drill down on that question a little bit and talk about one of the things that we're hearing on the street, really, from those conversations, whether it's at member meetings or it's at the investor conference, which is how do you actually make this work? And I think you got a unique perspective, both kind of from the investor perspective as well as having been in the industry for a long time, of that where people are intersecting. What we're hearing from the investors is they're coming out of meetings and say, we have a lot of capital right now, we want to invest it, and we see the benefits of the equipment finance space, having both the asset as well as the return, very strong place for us to make those investments. Then what we're hearing from our colleagues across equipment finance is, they want to make those deals happen, but they may not have that deal today, and those windows aren't overlapping. And so when the deal comes, the dollars may not be available from the investors. When the investors are ready to invest, maybe they have more to invest than kind of what those originations actually are. What advice would you have for both audiences, both our investors who are saying, I'm trying to learn more about the equipment finance space and how we can make a deal happen, as well as kind of the equipment finance space about how they should be engaging with investors today so that when the right opportunity comes up, they're set up for success?
First of all, let me say one of the interesting parts of our industry is, and one of the most important bits is that the way equipment gets sold is very different from market to market. So again, back to selling a pizza oven and selling a backhoe, that sales process is very different. And so the way that you finance those two pieces of equipment and access that borrower or that obligor from those two markets is quite different. And so that sort of diversity of sales channels is what has been one of the interesting parts of the business and what creates this great diversity. In addition, the other cause of diversity in our industry is the fact that underwriting a restaurant owner and underwriting a construction company, pretty different. They could have the same FICO, same time in business, same PayNet, but they're going to perform differently. They're going to perform differently in different markets. The underlying collateral matters in terms of how you assess the risk. So these differences is why we can support so many businesses in our industry, so many different niche players or players in single segments. Now, if you're an investor, you've just got to understand kind of where the value is created in the market. Like to me, it's how do you access that end customer and how you do it effectively, and how are you solving the problem, which is the small business or the business owner wants to use a piece of equipment and they want to have it easy and fast, and they want to get access to it, and they want to match the funding cost with the useful life of the equipment. If they've solved those problems and they've gotten the money easily and quickly, they can. There's value there. There's value in excess of the present value of the cash flow itself, and it's that creation of value which is what all originators are looking to do, and understanding that value creation and why a particular portfolio is worth what it is kind of an important component to how an investor thinks about the business as well.
That's great. And I think, kind of what you're reinforcing is the importance of like the education on both sides, exposure to the equipment finance industry, to the investors, and for the investors to learn certainly more about the work that we're doing, and our members understanding how they can interact more effectively, and how do they create that value case for the capital, which
Yeah.
is, go ahead.
Oh yeah. Let me add something from the sort of originator leasing company perspective, which is the objective isn't necessarily just to find the lowest cost of funds, right? There's this idea that somebody told me years and years ago. It's Droom, right? Don't run out of money. So, but the idea is you want to build a diverse group of investors who understand your business, who are with you through thick and thin, whose commitments mean something, who are flexible to changes in the market and the product and the business. Those qualities in an investor are what reduces the risk for the business owner, for the originator who is trying to be successful in the business and wants to withstand business cycles. And back to sort of that infrastructure layer, taking those things off the table, itself widens the pool of potential investors. The broadest pool that you can have in potential investors, you'll end up with the best investor. Whereas if only one or two people are knocking on your door, you should ask yourself why, and so creating this investing in the trust layer broadens the investor base and allows you to really pick and choose who your investors are for the qualities that are important to you. Leverage, price, flexibility, commitment, all those qualities of the money that make a huge difference through business cycles.
I think that's going to be really helpful, and I know these conversations are evolving, and it's probably not surprising that we got a few questions from members that they want to make sure we address as well. So I'm going to go through a couple of them before we wrap up our time today. So, as you're thinking about the role of technology and securitization, how are platforms like Concord using it to help reduce friction for our investors?
Wow. So I think about it from two different perspectives. Okay. So there is the act of pooling and securitizing assets, but then there's also the issue of liquidity within the contracts themselves. So we as an industry generate liquidity by securitizing, but also selling portfolios in ones, twos, tens, hundreds, and so there's a question of liquidity both at the securitization level and at the individual contract level. And so we're back to this question of standardization, which is eliminating the unknowns from any of those processes increases liquidity. So if you have a custom contract with features that nobody understands or hasn't been tested in a legal process, you're not going to have as much liquidity for that contract. If you're in a market segment with a product type that is untested or hasn't been sold in the secondary market or recovered in the secondary market, you're going to struggle with liquidity. So, I focus on kind of how do you most broaden the applicability of what you're doing, and standardize the things that can be standardized, and then make unique the things that differentiate you and create the value. And that's just using best in class processes and services, and removing that correlation risk between the originator and the portfolio or the pool of assets. But you said more specifically technology. So this is a back to the data question, which is we're getting to a point where the demand for transparency is just not going to stop, and how we address it as an industry, what standards we choose to use for that level of transparency, and creating a consistent agreement as to what we want to share and what is our special sauce, I think will help us in the long run kind of standardize and create more liquidity for both, pooling assets for securitization or selling pools.
I mean, well, if there's one thing that's clear from today's conversation, it's certainly this. There's a huge opportunity right now to invest in and scale equipment finance. We know that the sector is highly investable, but we also know is that the scale requires more than just attractive asset. It also requires infrastructure that investors can trust. And that trust layer of infrastructure is so important. There's a huge need for it right now, which explains why companies like Quentin's are leaning into the area. Quentin, I really want to thank you for joining us today and sharing your expertise. But before we wrap, where can folks find you if they want to follow up?
So you can find us on the web, and also on the ELFA directory. So we're in both places, and we'd love to talk to you.
Awesome. And then if people want to learn about what Concord does specifically, their web address is concordfinance.com. So thank you, Quentin, and to the Concord team. We appreciate it and look forward to seeing you in person soon at the next ELFA event or an industry conversation.
Thanks, Daryl.